Welcome to The Deep Dive. We're the show that, well, we take a whole stack of information, all the analysis, and boil it down to what you really need to know. Just a shortcut to getting informed. Today, we are plunging right into the heart of the market. We're talking the S&P 500. It's currently sitting right around the 5,980 mark. And honestly, feels like a pretty pivotal moment, a real crossroads. So our mission today is simple: distill all these complex signals we're seeing. We've got fundamental economic stuff, intricate technical charts, you name it. We want to give you a clear, really well-informed handle on what's actually happening, beneath the headlines and what moves might be next for the S&P 500. Is this the time to, BUY the dip? Or should we be thinking RUN before it crashes? Let's explore the evidence.
Exactly. And looking at all these different sources together, it's not just about listing things off, is it? It's about connecting the dots. We want to paint that holistic picture, show how the fundamentals, the risks, the charts, how they all kind of interact. We'll definitely get into the optimistic side, the growth potential, but also look hard at the serious risks that could shake things up, give you that balanced view.
Okay, let's unpack this S&P 500 crossroads. First off, just a quick snapshot. Where are we right now? So June 2025, S&P 500 trading, like we said, around 5,980. And just for context, that's, well, it's just a bit shy of its all-time high. That was 6,144, hit back on February 19th this year. Pretty recent. Mm-hmm. And it's also, importantly, a solid recovery from that correction we saw back in April 2025. Remember that? It dipped quite a bit.
Oh, yeah. Down to around 4,983. That felt pretty sharp at the time.
It did. So definitely seen some volatility, but also, remarkable resilience to get back near these highs.
So we're here at this crossroads. One path seems paved with, well, what many see as strong fundamentals pushing upwards. Let's explore that first, the bullish case. What's fundamentally giving investors that confidence right now?
Well, there are a few key things analysts are really leaning on. First up, earnings growth. The projections are, frankly, pretty impressive. Analysts are looking at around 9% earnings per share growth, EPS growth, for 2025.
Okay, 9%. That's solid.
It is. And what's more, it's expected to actually accelerate from there, maybe up to about 12% through 2027. And that's not just a little bump. That kind of consistent accelerating growth, it's a powerful engine for stocks. It's just companies are getting more profitable.
Right, which should support higher prices, theoretically.
Exactly. That's the fundamental pull upwards. Then there's valuation. The forward price to earnings ratio, the PE, it's currently sitting near, let's say, 21 to 22 times.
That's a bit higher than usual, isn't it? Well, it is. It's definitely above the 5-year average, which is more like 19 times.
Right.
But, context matters. With that strong earnings growth outlook we just talked about, many analysts think, well, maybe that valuation is justified. It sort of suggests investors are willing to pay a premium now for that expected future profitability, if you believe the growth forecasts, that is.
Okay, makes sense. What else?
And then there's a really critical piece: demand drivers, consistent demand. Think about U.S. retirement accounts, your 401ks and things like that. They are a huge and very consistent source of demand for stocks.
Right. People just keep putting money in month after month.
Exactly. It's not speculative hot money. Mm-hmm. It's steady, often automated, long-term savings flowing in. And that structurally weighs against bonds, keeps capital flowing into equities pretty robustly. It's like an underlying, almost automatic buying pressure.
Interesting. A constant tailwind almost.
You could put it that way. And then look at what the big firms are saying. Goldman Sachs, Morgan Stanley, they're actually quite optimistic. They're putting targets out there, forecasting the S&P 500 reaching maybe 6,500 within the next 12 months.
Wow, 6,500?
Yeah. I mean, these aren't just random guesses,
Yep.
right? They're based on their models, forecasts.
Sure.
And that suggests, maybe an 8 to 10% upside from where we are now, which is a pretty healthy projection. Signals that big institutions still see room to run.
Okay, those are definitely compelling points for the bulls. Solid foundation, but any crossroads has dangers on the other path. What are the counter forces, the risks that analysis suggests could pull things the other way, derail this optimism?
Absolutely. You always have to look at the downsides, the what ifs. And right now, the big one analysts keep flagging is geopolitical tension, specifically the situation between Israel and Iran. There are, serious concerns that if that escalates, it could trigger a really substantial market sell-off. Some are suggesting maybe even 20%.
20%. Wow. How would that play out?
Well, think about oil supplies. An escalation could disrupt global oil, send energy prices spiking. And that hits everything, right? Transport costs, manufacturing. It dampens spending, hurts profits, shakes confidence.
Right. Ripple effect.
Exactly. And that could potentially push the S&P down towards, say, the 4,800 to 5,200 range, which would be a major correction, wiping out a lot of this year's gains.
Okay, so that's a big external shock risk. What else?
Beyond geopolitics, there are these broader macro headwinds that just won't seem to go away. We're still dealing with what people call sticky inflation, inflation that's just proving harder to tame than hope.
Still lingering.
Yeah, stubbornly elevated. And that keeps interest rates higher, which means borrowing costs stay up for companies. That directly hits their bottom line, their expansion plans.
And for consumers too, right? Mortgages, loans.
Absolutely. Erodes purchasing power, makes big purchases more expensive, slows down spending, dampens the whole economy. And then you've still got ongoing tariff risks potentially bubbling up, disrupting supply chains, adding costs. These things, individually or together, they can definitely chip away at confidence and performance.
So definitely not a straight road ahead then. We've got this undeniable underlying strength you mentioned, but also some pretty significant storm clouds brewing. How do you even start to reconcile these? This is where I guess the technical analysis comes in. Looking at the charts, it gives us clues about momentum, key levels, maybe where the smart money is flowing, right? It's interesting that even with recent dips, the S&P held above its 50-day moving average. That's often seen as positive. But what do the charts really tell us at this crossroads?
That's a great point. And yeah, the technical picture adds a whole other dimension here. Let's break it down, maybe look at different time frames. Starting with the big picture, the monthly chart. The SPX 500 trend index, it's been trading inside this really well-defined ascending channel. Think of it like an upward sloping corridor. It actually started way back in March 2020.
Okay, so a long-term pattern.
Very long-term. And the price action within it is classic uptrend stuff. Higher highs and higher lows. Each peak higher than the last, each trough higher than the last. Very strong, consistent uptrend.
Clear signal.
It is.
It is.
But, and this is where it gets interesting, on the same monthly chart, we're seeing what's called a bearish divergence starting to form.
Okay, what does that mean exactly? Bearish divergence.
Think of it like this. The price is still making new highs, but the underlying momentum, measured by technical indicators, isn't keeping pace. It's lagging behind.
Oh, okay, like the engine sputtering even as the car inches forward.
That's a pretty good analogy, yeah. It doesn't guarantee a crash, but it suggests that powerful bullish momentum might be starting to slow down, at least in the near term. It's a yellow flag, something to watch on the long-term horizon.
Got it. So long-term trends strong, but maybe losing some steam. What about shorter time frames, like the weekly?
Right, liming into the weekly chart. The index is trading, like you said, quite close to that all-time high resistance zone, around $6,100. But importantly, the price is still holding well above its 50-day exponential moving average, the EMA. That's usually a strong sign of trend continuation on this time frame. The weekly trend is still robustly up. Now remember that April dip you mentioned, where it tested that key demand zone between $4,900 and $5,200?
Yeah.
What's fascinating is that zone lined up almost perfectly with the lower boundary, the lower trend line of that big ascending channel we saw on the monthly chart.
Okay. So multiple technical factors aligning there.
Exactly. And what happened next? A really strong bullish rejection from that zone. And crucially, it happened on ultra high volume.
High volume, meaning?
High volume on a bounce like that often signals what we call smart money accumulation. Big institutional investors stepping in decisively, seeing value, and buying aggressively at those lower levels.
Right. They saw it as an opportunity.
Precisely. That provides some confidence in that lower zone as significant support.
Okay, so monthly shows a strong channel with maybe a warning sign. Weekly shows resilience near highs and strong buying at dips. What about the really short term, the daily chart?
Zooming in again, the daily chart shows the index trading within a pattern called a rising wedge.
A rising wedge. Okay, what does that look like?
Imagine two upward sloping lines, but they're converging, getting closer together. The price is bouncing between them.
Okay.
It often signals that the upward momentum is kind of coiling, maybe getting exhausted. And typically when the price breaks out of a rising wedge, it's often downwards, signaling a potential short-term correction.
So the daily chart suggests maybe some near-term downside risk.
Potentially, yeah. Based on this pattern, what we might anticipate is maybe a retest of the $5,900 support level first. After that, maybe another attempt to push higher, back towards that $6,100 resistance zone.
Okay.
Now, if it hits $6,100 again and fails to break through, well, then there's a real possibility of a deeper pullback. perhaps toward that $5,200, $5,500 zone we talked about.
Which you identified as a major demand area earlier, right? Where the smart money stepped in.
Exactly. That zone could act as strong support again. And from there, potentially, the index could launch a new impulsive move upwards, either retesting $6,100 again, or maybe finally breaking through for more upside in the coming weeks.
Okay, so a few potential near-term paths there, hinging on those key levels.
Yes. So if we try and tie all this technical analysis together, connected to the bigger picture, what are the key takeaways for navigating this crossroads? First, the overall trend, big picture, is strongly bullish. That's intact across the monthly and weekly charts. Higher highs, higher lows, that ascending channel.
Right, the underlying structure is still positive.
Definitely. Second, key resistance is clearly $6,100. That's the level to watch for a breakout or another rejection. Third, support zones. We've got $5,900 as short-term support, but the really major demand zone, the crucial area, seems to be between $5,200 and $5,500.
Sure.
Fourth, the structure. While the higher time frames show that HHHL bullish structure, the daily chart has that rising wedge, hinting at potential short-term caution or correction. And finally, volume, that strong buying volume we saw near the major demand zones back in April. So that confirms institutional interest, adds weight to those support levels. It shows underlying strength even during pullbacks.
Wow. Okay. That was an incredibly thorough deep dive. We've really covered a lot of ground there. From the compelling fundamental strengths, the earnings growth, the 401k demand, painting that bullish picture, but also staring squarely at those pretty significant geopolitical risks, the macro headwinds, that could easily trigger a pullback.
And then overlaying all of that with the technicals, the long-term channel, the bearish divergence warning sign, the short-term wedge, those absolutely crucial support and resistance levels. It really feels like you, listening now, should have a much better grasp of all the different forces pulling and pushing on the S&P 500 right now. Those conflicting signals are clearer.
Exactly. It's rarely simple, is it? And maybe just a final thought to leave you with as you watch how this market unfolds. Given that strong underlying bullish trend, confirmed by volume and those higher time frames, but also tempered by the short-term technical patterns and obviously those very real geopolitical and macro risks, maybe consider this. How resilient is that underlying structure? Can it continue to absorb these significant short-term pullbacks we might see? Could moments of correction actually turn into opportunities, especially if the price dips back towards those key demand zones, like $5,200 to $5,500 that we discussed? It's a complex interplay. Understanding these different layers, the fundamentals, the risks, the technicals, is really key to navigating whatever comes next. Something to ponder.